Have you ever noticed the impossible? Interest rates are sky high, yet the U.S. housing market simply refuses to crash. For 2 years, every expert has waited for the bubble to burst, but the data tells a different, far more complicated story. The truth is, the market isn't collapsing, it's paralyzed. And the reason comes down to one catastrophic term: the rate lock disaster. Back in 2020 and 2021, millions of Americans locked in mortgage rates between 2 and 4%. That was cheap money. Today, the going rate is 7 to 8%. Think about the math. If you own a home with a $1,500 monthly payment at 3% and you sell it to buy a new one, your new payment at the same price could easily jump to $3,500. This isn't just an economic disincentive, it's a financial trap. Homeowners are effectively locked in their current homes. They cannot afford to move, and this is the bottleneck choking the entire U.S. real estate market.
This trap has led to an unprecedented collapse in housing inventory. People who would normally upgrade, downsize, or relocate are simply staying put. When supply vanishes, but underlying demand remains, driven by population growth and a stable job market, prices don't fall. They stabilize at ridiculous highs. This gridlock is most visible in major metropolitan areas. Take Austin, Texas, a booming tech hub, but inventory is chronically low because the 2021 buyers are stuck. Or look at Seattle, Washington, and Boise, Idaho. These markets are seeing less than half the normal listing volume. The rate lock phenomenon ensures high demand chases shrinking supply, defying the logic of high interest rates.
And here is the brutal irony. This high-rate environment only hurts those who need a mortgage. The segment of cash buyers, wealthy investors, corporations, and foreign buyers are entirely immune to the rate lock. In fact, they view rising rates as a competitive advantage, as it removes mortgage-dependent first-time buyers from the bidding war. This influx of cash purchases helps prop up prices, further cementing the market's defiance against gravity.
If this deep dive is helping you navigate the market's chaos, please hit that subscribe button right now. Your support helps us keep bringing you the unvarnished truth about the economy every week. Now, let's look at what 2025 truly holds.
So, when does this gridlock end? The answer depends entirely on the Federal Reserve. Scenario 1. The soft landing. If the Fed can safely reduce interest rates to the 5 to 6% range by late 2025, the rate lock will weaken. A small wave of inventory will hit the market as people finally feel financially comfortable moving again. This will create a temporary, moderate price correction, perhaps a 5 to 10% dip in certain markets. Scenario 2. The deep freeze. If rates stay anchored at 7% or higher, the crisis becomes one of stagnation. The market will remain frozen, inventory will stay low, and housing affordability will only worsen. The crash everyone hopes for will transform into a permanent accessibility crisis for first-time buyers.
JP Morgan recently stated that the rate lock is the single largest factor preventing a price correction. The true crisis is not a spectacular crash, but a creeping paralysis. For buyers, the time to wait for a crash may be over. The shift in rates will likely bring a slight correction, not a collapse. For sellers, your leverage remains, but only if you accept the reality of buying into a higher rate environment yourself. The market is not collapsing. It is simply waiting for a new normal. What's your prediction? Will the Fed cut rates or hold steady? Drop your forecast in the comments below. Don't be caught waiting for a crash that has already been replaced by a stalemate.